Greetings, everybody. Welcome to Liberty Call. Today is Friday. Woo, end of the week. It is August 18th, 2023. Hope everybody's having a fantastical day out there. You can see my boy Jake back here. He is super excited for the weekend because that means more ball time. All right. Not the greatest day in the markets, unfortunately. It looks like the Dow managed to finish the day in the green, but everything else looks ugly. But again, not really to be... this is not unexpected. If you've been watching along and paying attention to the data that I provide on a weekly basis, this is not shocking. All right. Well, before we get into the numbers for today, if you could, thank you very much for being here. And if you could also give me some thumbs up, a like, a share, a subscribe, follow, hit the notification bell so you know when I go live, because you don't want to miss this amazing content. This is some of the best stuff on the interwebs. At least I think so. Alrighty, let's go ahead and jump into the numbers. Dow Jones was up 0.08%, 26 points, closed at 34,500. S&P 500 was flat, down 0.01, closed at 4370. NASDAQ down 0.2, closed at 13,290. The VIX down 3.24%. It's down to 1731 right now. Canada was up 0.03, Brazil up 0.38, and Mexico down 0.06. Over in Europe, Germany was down 0.65%, same with the UK. France was down 0.38, Netherlands down 0.35. Spain was down 0.11%, Italy down 0.42%, same with Switzerland, and Portugal was up 0.07. Russian exchanges both in the green. MOEX up 1.71, the RTSI up 1.76, and the overnights in Asia mostly red. The Nikkei in Japan was down 0.43%. Australia up 0.03. New Zealand down 0.23%. In China, the Shanghai was down 1% even. Shenzhen Component down 1.75%. China 50 down 1.05%. DJ Shanghai down 1.23. Hang Seng down 2.07. And the Taiwan weighted came in fairly flat at down. Oh, actually, that one was still closed, not open since the 16th. All right. So, like I said, not the best day and not the best week here in the markets. But let's go ahead and bring up our charts, and we'll look at the weekly numbers, starting out with the Dow. Alrighty, Dow is going to finish the week off down about 2.08%. The S&P 500, where's the line? There it is. Is going to finish the week off down 1.89. The NASDAQ finishes the week off down 1.8. Dow Transports down about 265, and the Dow Utilities finished the week down about 1.72. Yeah, earlier today I looked at the Dow and the S&P, and they were down 2.2%, like basically the same. Looks like they came back up a little bit here in the last little bit of the trading day. All right, let's go ahead and zoom out. Take a look at the bigger picture and see how things are lining up. This right here is the beginning of the downtrend for the Dow last January of 22. Broke the downtrend late last year, traded sideways for a number of months, and it looks like we're going to probably break this uptrend or sideways movement that had really been lining up since about springtime. So if it blasts through this, that'll, in my mind, solidify this downward trend that's starting to shape up. Same thing with the S&P 500. Beginning of last year, began this downtrend, broke through the downtrend early part of this year, and this uptrend looks like it's probably coming to an end if we blast through this here in the next couple of trading days. So again, it's lining up really good here for a downtrend. And if it breaks this line of resistance, it pretty much tells us that things are, we're going to break at least this longer term trend. So anyways, beyond that, really can't say, but it's not too good, unfortunately. All right, let me close that. And let's go ahead and jump over to the economic data that came out this week, starting out with jobless claims. Initial jobless claims came in at 239,000, just under the 240,000 forecast. Last week's number was 250K. Continuing jobless claims came in at 1.716 over the forecast of 1.7. Last week's number was 1.684 million. Retail sales year over year grew by 3.17%. Forecast was only 1.5. Last month's number was 1.59. The month over month number was only 0.7% growth. Forecast was 0.4. Last month's number was 0.3. All righty, housing starts. We talked about this earlier in the week in one of the articles I covered. Housing starts came in at 1.452 million. Forecast was 1.448 million. Previous number was 1.398. And month over month, housing starts grew by 3.9%. We were forecasting 2.7. Last month's number was a 11.7% contraction. So definitely some positive news there. Industrial production year over year contracted at 0.23%. The forecast was a contraction of 0.1. Last month's number was a contraction of 0.78. Month over month, industrial production grew by 1%. Forecast was 0.3, so beat forecast. And the index of leading economic indicators came in at a negative 0.4, right on forecast. Last month's number was a negative 0.7, so it has improved a little bit there. And I believe that's it. So let me see if there's anything else. Yep, that was all as far as data this week. It's pretty light. And there also weren't a ton of earnings if you were watching our Monday show. All right, let's go ahead and get to the market recap. Wall Street mixed as energy defensive sectors counter megacap declines. Wall Street's primary indices experienced a mixed and nearly unchanged session on Friday as a dip in megacap growth stocks offset gains in defensive sectors and energy. Most notably, megacap technology-related growth stocks like Alphabet and Tesla faced declines, reflecting concerns among investors about the potential for sustained higher interest rates. With no significant driving forces influencing the markets, attention shifted towards Federal Reserve Chair Jerome Powell's upcoming speech at Jackson Hole Economic Symposium for insights into the interest rate outlook. I think that's sometime next week. The S&P 500 communications sector index registered the most significant drop among the 11 sector indexes, falling by 1.2%. Conversely, defensive sectors like consumer staples and utilities helped limit the losses. Energy companies also performed well, with ExxonMobil climbing 1.3%, contributing a 0.7% rise to the S&P 500 energy index. On the one of the day's significant moves involved Estee Lauder, which saw a decline of 2.6% after the cosmetics manufacturer projected its annual net sales and profits to be below street estimates. I mean, you would think their sales would be going through the roof with all the trannies out there putting makeup on, but what do I know? Wall Street's major indexes faced notable weekly losses influenced by robust economic data that prompted investors to revise their expectations for interest rate cuts, leading to an increase in government bond yields. The prevailing sentiment suggested that equities were overdue for a correction, with higher interest rates being a significant catalyst for the shift. I've been saying this for a while. Benchmark 10-year U.S. Treasury yields retreated from a 10-month high after approaching levels that could have marked the highest since 2007. Market participants predicted a near 91% probability of the Fed maintaining current interest rates at its upcoming September meeting. I am in the other camp. I think they're probably going to raise rates at least 0.25%. Notably, the NASDAQ, which is technology heavy, posted the most substantial weekly declines among the three primary indices, experiencing a drop of nearly 3%. The CBOE Volatility Index, often referred to as the VIX, also reached its highest level in nearly 3 months, reflecting growing investor anxiety. Take your Zoloft, folks. Some notable individual movements included Hawaiian Electric shares surging by 13% after the utility firm expressed its intention to avoid restructuring. Meanwhile, shares of cryptocurrency firm Coinbase Global fell by 2.3%, and Riot Platform experienced almost 5% drop as the price of Bitcoin hit a 2-month low. Yeah, I think what I saw yesterday was that SpaceX sold off all their Bitcoin, and Bitcoin went from like 29 to 26, pretty big, decent jump yesterday afternoon. Advancing stocks surpassed declining ones on both the New York Stock Exchange and NASDAQ with ratios of 1.25 to 1 and 1.29 to 1, respectively. The S&P 500 saw no new 52-week highs and 17 new lows, while the NASDAQ composite recorded 18 new highs and 211 new lows. All right, so kind of a, just a meh week here. All right, next up. Comes from Zero Hedge, titled Yet Another Biden Regulation Will Increase Cost and Promote More Inflation. It's written by Mike Shedlock via mishtalk.com. Let's see what he has to say. The Biden administration's policy changes are raising concerns about potential consequences such as higher taxes and decreased availability of goods and services. A major focus is on the Davis-Bacon Act, a federal law that mandates paying local prevailing wages on public works projects. Redefining how these wages are determined could lead to increased costs for government projects, including wind turbines, EV charging stations, road repairs, and other federal construction undertakings. Personally, I'm hoping that the federal government collapses before the next election, so all this stuff is going to hopefully be moot. But anyways, the shift allows the Department of Labor to adopt prevailing wages set by state and local governments rather than relying on contractor surveys. This change could lead to varying wage levels in different regions and industries. The new rule extends to areas like broadband, solar panels, wind turbines, and electric vehicle charging stations that receive partial funding from the government. I'm not sure why they're receiving a dime from the government. These are not jobs or within the jurisdiction of the central government. Furthermore, the Inflation Reduction Act incorporates bonus tax credits, and that's in quotes, for renewable projects adhering to the prevailing wage, potentially raising costs for green energy initiatives. This may exceed the previously estimated $1.2 trillion, according to Goldman Sachs. It kind of smells like Solyndra. I don't know, maybe. The administration's policies are raising concerns about inflation across multiple sectors. Initiatives such as the push for clean energy, cap and trade policies, deglobalization, tariff sanctions, and a drive for more unions are seen as potential contributors to inflation. The administration is also implicated in the rising price of rent, contributing to the consumer price index's 0.2% rise, a trend observed over 18 months. The United Auto Workers Union is also demanding significant benefits, including a 32-hour work week. Wow. I mean, you build cars on an assembly line. I can't imagine it's that taxing. A 46% pay raise over 4 years. Yeah, okay. And the right to strike over plant closures and increased retiree benefits, among other demands. Yeah, I mean, unions and government workers are the laziest humans on the planet. These policies are prompting concerns that President Biden's actions may fuel inflationary pressures in various sectors with possible negative repercussions on the economy if these policies persist. Yeah, well, it doesn't matter if they're blue or red. I hate both sides of the government. They're all evil. Alrighty, and they just try to make our lives miserable. Last up, some food for thought comes from our friends over at Business Wire. It's titled Monetary Inflation Won't Create Economic Growth. It seems to be a trend here. Inflation, inflation, inflation. All right. The core question in economic and political discussions is whether altering the quantity of money can lead to an improved or deteriorated economic state. This query has roots in historical and economic thought. Aristotle's perspective on money as a medium of exchange influenced medieval thinking, shifting the focus away from economic implications of money changing money supply. Classical economists like David Hume, Adam Smith, and Etienne de Condillac agreed that money's quantity was irrelevant to a nation's wealth. However, the 19th century saw a shift in monetary institutions. While the gold standard era is sometimes idealized, even then, governments controlled coinage, often using price controls and fractional reserve banking. This allowed inflationary paper currencies to gain prominence. The classical economists' insight that money supply changes didn't affect wealth got overshadowed by later generations, such as Irving Fisher, Newt Wicksell, Carl Helfferich, and John Maynard Keynes. These economists campaigned against the gold standard, arguing that the printing press could boost employment and growth in the short run. And anyone who knows anything about Keynesian economics knows that that is a disaster. Granted, the left loves it. Despite the allure of short-term benefits like employment and growth, the long-term consequences of inflation are substantial. Inflation erodes purchasing power, leading to unprecedented debt growth on various levels, government, corporate, and individual. The shift from firms being financed by revenues to heavy reliance on banks and intermediaries is partly due to paper money. Governments have also expanded their control through paper money's financing capabilities. The belief that inflation addresses sticky wages, where wages don't quickly adjust, is questioned. Inflation's impact on wages is limited by how much workers can afford to remain unemployed due to reduced purchasing power. In a free labor market, wages tend to be flexible, but government interventions can create stickiness. Furthermore, the idea that inflation reduces unemployment by fooling workers is critiqued. Workers' behavior is constrained by their savings. Inflation success in overcoming the problem of sticky wages depends on the ability of paper money producers to surpass labor unions. In conclusion, the discussion about the impact of changes in the money supply on the economy's well-being spans history. While short-term benefits like increased employment and growth are often attributed to inflation, its long-term consequences, such as erosion of purchasing power and the transformation of financial structures, are significant. The belief that inflation addresses issues like sticky wages and unemployment is questioned when considering the complex interplay of economic factors. Yeah, I'm a big proponent of sound money, but that's me. All right, well, that's everything I had for today and for the week. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening and a wonderful weekend, and I'll talk to you next time. Adios.